In this video, we're going to be going over Chapter 20, Money in Financial Institutions and the Federal Reserve. Money's important, folks. You have to have it. And we'll talk about the money supply, the banking system, using technology to make banking more efficient, and then just touch briefly on international banking. Now, money. Everybody needs it, all right? It's anything that's accepted for payment. It used to be that we bartered. In other words, okay, tell you what, I'll trade you a sheep for a cow, all right? Well, money makes it easier to make some of those transactions. Now, when you think about money and the forms of it, it needs to be portable, divisible. In other words, I will never carry anything larger than a 20. And the reason is because it's so much harder to break it, okay, in various places. It needs to be stable, durable, and unique. Now, Bitcoin, or electronic money, is becoming big today, and it's a newer form of money. In the United States, we talk about the money supply. All right, that's the amount of money that's actually in the economy. There are three types. You have M1, which is cash and checks. You have M2, which are time deposits, in other words, savings accounts, things like that. And then M3, which is the time deposits plus some of the big institutional money market funds that are out there. And what's interesting is some facts about money. In 2013, we were printing 37 million bills a day. The thing is, most of those were going overseas. The ridges on coins are to prevent counterfeiting so that you don't have, phony coins that's going around. And it actually costs more to make a penny and a nickel than they're actually worth. So it's really kind of interesting as far as some of the money and some of the facts that go with it. One of the things we need to do as far as the economy is concerned is manage inflation. Now, inflation is basically where the prices are going up. In other words, let's say that you have three people who are trying to buy a gallon of milk. Well, one of them is going to be willing to pay a little bit more for that gallon of milk than some of the others. The price is going up. Deflation is where prices are going down. So you might have 6 gallons of milk and one person who's there to buy it. So the producers for those gallons of milk are going to drop the price to try to sell it. A falling dollar value is basically saying that the amount of goods and services that we can buy decreases. Rising value says we can buy more with that dollar. And that is all based on what's happening with some of the other global economies and things that are going on overseas. Now, the money supply is controlled by the Federal Reserve. And you may hear about various things in the Federal Reserve. In the news, you'll hear about the Board of Governors meeting. You'll hear about the Federal Reserve banks and things like that. The Federal Reserve is responsible for monetary policy. In other words, how much money is in the economy. The president and his administration is responsible for fiscal policy. How is money spent by the government? So there is a difference there. The Federal Reserve is a governmental agency. The thing is, it's supposed to be completely separate from the administration. There are 12 Federal Reserve banks. We have one here in the Kansas City area. And what they do is they make sure that things are happening as far as the economy is concerned. For example, when they control the money supply, they have several ways of doing it. They have a reserve requirement. In other words, commercial banks have to keep a certain percentage of the cash that people deposit with them in-house. Open market operations are where they buy and sell government bonds. In other words, a government bond is where the federal government is borrowing money. And by selling or buying those things, they can regulate the amount of money that's in the economy. They also regulate the supply of money by the discount rate. In other words, it's the interest rate that the Federal Reserve charges to member banks for loans. The control method for increasing, the reserve requirements actually says, okay, there's going to be less money available to lend to customers. See, banks make their money from making loans. They take in checking accounts and savings accounts and things like that. Those are actually liabilities to the bank because they owe you that. They make their money then, they use that money that you put on deposit and they make loans with that. They have to keep a certain amount in-house in order to back up some of the loans that they have. The higher the reserve requirement that the Federal Reserve puts slows the economy because there's not as much money to lend. If they decrease the reserve requirements, then there's more money for banks to lend and the economy speeds up. If the Fed is selling bonds, in other words, people are giving money to the Federal Reserve for those bonds, they're taking on more federal debt, it's slowing the economy. If they are buying bonds, in other words, people out there have these loans, and what they're doing is they're buying them back, then what that does is speed the economy up because it's putting more money into the economy. The discount rate, in other words, the interest rate that is charged to banks when banks are borrowing money from the Federal Reserve, if they increase that rate, then it slows down the economy because the banks are having to pay more for those loans. If they decrease the rate, then what happens is they have more money to lend and the economy speeds up. They also have a check clearing role. So for example, let's say you have a farmer in Maryland who is buying a tractor from a tractor dealer in Austin, Texas. Well, the farmer gives the tractor dealer a check. The tractor dealer then deposits that check in his local bank in Austin, Texas. That bank then sends that to the Federal Reserve in Dallas and gets credit for it so it can go back to Maryland. Fed in Dallas sends that check over to the Fed in Richmond, Virginia, which is the closest Fed to the one in Maryland, to the bank in Maryland. They then send that to the bank in Maryland and then take that money out of the farmer's checking account. Now, a lot of times this stuff is done in just a day or two. The Federal Reserve was actually established in 1913, okay, because of some of the issues that were going on with the money supply in the United States. And in the Great Depression, where you had a lot of bank failures and people lost a lot of money because of some of those things, Congress passed the FDIC, the Federal Deposit Insurance Corporation. Today, what that does is they will guarantee $250,000 per bank. So if you have $250,000 and you have it in a bank, that bank fails, the FDIC will make good on your $250,000. You can see that there are some big banks here in the United States that have trillions of dollars, and that changes from year to year. Now, the banking system consists of commercial banks, savings and loans, credit unions, and non-banks. A commercial bank is a profit-seeking organization. In other words, they are in business to make a profit. They sell stock. You can buy stocks in commercial banks. They use the funds that people put on deposit with them, checking accounts, savings accounts, that sort of thing, to make loans. And they have two primary customers: depositors and then borrowers. The kinds of things that they do: demand deposits, that's checking accounts. In other words, you put money on deposit with a bank. You can write a check on that anytime. You can go in and demand your money back because that is your money. That's why it's called a demand deposit. It's actually a liability for the bank. The bank then lends that for people to buy houses and cars and companies to get equipment and things like that. You have time deposits, in other words, savings accounts, and CDs, or certificates of deposit. In other words, you put on deposit an amount of money for a particular time, say 90 days or 180 days. After that time, you get your money back plus interest. If you try to withdraw that money early, you don't get the interest, and they may even take some of your money. They also provide loans based on people's credit worthiness. This is why it's so important to keep a good credit score. Now, savings and loans are a little different. What they'll do is they will actually pay a little bit more as far as the money that you keep in a savings account than a commercial bank will. They also are focused more on home ownership. They do more home loans than they do most anything else. Credit unions are nonprofit, and what happens is you become a member of a credit union. You are one of the owners of that credit union when you're a member. They don't have to pay taxes because they're nonprofit, and because of that, they can charge less interest, or they can provide more interest in your savings accounts. Plus, if they do make a profit, or when they do make a profit, they give that back to the members who are the owners. Now, non-banks are things like life insurance companies. You can put money, you're putting money on deposit basically with life insurance companies when you buy a life insurance policy. Pension funds, in other words, your retirement accounts. There's various other non-banks that are involved in the banking system. Now, we did have a banking crisis some time ago, and there were a lot of fingers being pointed at everybody else as far as Congress, as far as banks, as far as the Fed, the Securities and Exchange Commission, various other people. So there was a lot of blame to go around. What happens is the FDIC, the Federal Deposit Insurance Corporation, which was created by Congress, will guarantee any deposit that you have up to $250,000. It's the same with savings and loans and credit unions. You will be covered up to $250,000. Now, if you have $500,000 and you have that on deposit in the bank, they will protect only $250,000. I don't know about you, but I don't have that much. There have been a lot of electronic technology advances over the past years. For example, electronic funds transfers. In other words, electronically passing along money from one place to another. For example, it used to be when I started going to work, I got a check, an actual check, whenever I got paid. And I had to go to the bank and deposit that check. Whenever I was going to pay a bill, I had to write a check. I remember early on, twice a month, I'd sit down and I'd pull out all the bills and I would write checks for each one of those bills. It took forever to do that. Today, my paychecks are deposited directly into my checking account. I pay all of my bills electronically. So I hardly ever write a check, an actual check. Most times I'm using a debit card if I'm buying something. It's like a check because the money is immediately taken out of your checking account. Thing is, it also looks like a credit card. And then there's smart cards that are coming out and other conveniences and things. One of the things that most people are preferring to pay by now is with credit cards. Now be careful. If you're paying by an actual credit card, you better be paying it off at the end of every month. Otherwise, you're going to get yourself in a world of hurt. If you're using your check cashing card, then that's something else. It goes actually to your checking account. There's cash. Checks are the lowest ways as far as how people are paying now. Apple Pay is really kind of interesting. That can be a real time saver or a saver of some sort. Several months ago, I went and did the grocery shopping. I got everything together. It was being rung up and everything. I reached for my wallet to pull out my debit card, and I left my wallet at home. Thankfully, I had my iPhone with me, and I was able to use my Apple Pay to go ahead and pay for it. When it comes to the international side, it's a little bit harder to transfer money back and forth. There are some intermediaries that will help that. First of all, you have what's called letters of credit. It's basically a promise by a bank to pay someone for something once certain conditions are met. For example, if the money doesn't come to someone from overseas when it should have, if they had a letter of credit, the bank would go ahead and pay for it and then try to go after the person who was supposed to pay it. Bankers' acceptances are also promises that banks will pay at a certain time. The intermediaries primarily for the international piece are the World Bank and the International Monetary Fund. The World Bank lends most of the money to less developed nations. And one of the things they do is they try to get deposits from the various countries as far as donations to help with that lending. The International Monetary Fund stabilizes the exchange between various currencies. Okay? So those are some of the key points from the chapter. If you have questions, let me know.